They wake up at 4 in the morning, eyes glued to their screens, hearts racing with every tick of the price chart. They've read the books, watched the tutorials, downloaded the fancy indicators that promise to reveal market secrets. They've even made a few winning trades that felt like pure magic. But 6 months later, most of them are still stuck in the same place, making the same mistakes, watching their accounts slowly bleed. Some quit altogether. Others keep repeating the cycle, convinced that the next strategy, the next indicator, the next guru's course will finally be the one that changes everything. The truth is, 90% of traders never escape what experts call the beginner phase, and it has almost nothing to do with intelligence or effort. Walk into any trading forum, any Discord channel, any social media group dedicated to trading, and you'll see the same pattern playing out thousands of times over. Enthusiastic newcomers sharing their first wins, their excitement palpable through the screen. Then silence. Or worse, desperate questions about why everything suddenly stopped working. The beginner phase isn't just a stage, it's a trap. And understanding why so many people get stuck there reveals something profound about how markets actually work, and how human psychology collides with the cold mathematics of probability. The first problem starts before a single trade is ever placed. Most beginners enter the market with a fundamental misunderstanding of what trading actually is. They see it as a game of prediction, a puzzle to be solved, a code to be cracked. They believe that if they just study hard enough, find the right pattern, learn the secret technique, they'll be able to consistently predict where prices will go next. This belief is reinforced everywhere they look. Trading advertisements show confident people pointing at charts with absolute certainty. Social media influencers post screenshots of massive wins, implying they knew exactly what would happen. Course sellers promise systems with 80 or 90% win rates. But here's what nobody tells beginners until they've already lost money. The market isn't a puzzle with a solution. It's a probability distribution with random noise layered on top of subtle statistical edges that appear and disappear like ghosts. Professional traders don't predict the future. They manage probability and risk across dozens or hundreds of trades, knowing that any single trade is essentially a coin flip with slightly weighted odds. That distinction might sound semantic, but it's the difference between success and failure. When beginners don't understand this, they approach trading like students approaching a test. They study hard, they practice, they develop a strategy, and then they expect consistent results. When those results don't materialize, when they hit an inevitable losing streak, they don't think their risk management was wrong, or their position sizing was off, or they got unlucky within normal parameters. They think their entire approach is broken. So they abandon it and start over, searching for something better, never staying with any single approach long enough to see how it performs over a meaningful sample size. This creates what's called strategy hopping, and it's one of the primary reasons traders stay stuck. Imagine trying to learn a language by studying Spanish for 2 weeks, getting frustrated that you're not fluent, switching to French for 2 weeks, then German, then Mandarin, cycling through languages forever without ever achieving competence in any of them. That's exactly what most beginner traders do. They try momentum trading until they hit a few losses, then switch to mean reversion. They try technical analysis until it fails, then switch to fundamental analysis. They trade stocks, then futures, then forex, then crypto, always chasing the thing that seems to be working right now for someone else. The market has a cruel way of punishing this behavior. Each trading approach works during certain market conditions and fails during others. Momentum strategies make money during trends, but get chopped up during consolidation. Mean reversion strategies make money during range-bound markets, but get destroyed during strong trends. By the time a beginner notices that something is working and switches to it, the market conditions that made it work are often already changing. They're perpetually one step behind, arriving at every party just as it's ending. Underneath all of this is a deeper issue that most traders never confront directly. Trading forces you to face your psychological weaknesses in the most uncomfortable way possible. Every fear, every insecurity, every cognitive bias you possess will eventually show up in your trading, and the market will punish you for it with mathematical precision. Most people go through life never really testing the limits of their emotional control, their patience, their ability to handle uncertainty. Trading tests all of those things every single day. Consider what happens in a typical beginner's mind during a losing trade. They enter a position based on their analysis, convinced they're right. The price immediately moves against them. Now they're facing a small loss, but they don't want to take it. Taking the loss means admitting they were wrong, and humans are wired to avoid that feeling. So they hold on, hoping the price will come back. Sometimes it does, which reinforces the behavior. But other times, it keeps going, and the small loss becomes a medium loss. Now they're really committed. They've already lost this much, they reason, so they might as well wait for it to come back. This is the sunk cost fallacy in action, and it's devastating to trading accounts. Meanwhile, consider what happens with winning trades. The beginner enters a position, and it immediately moves in their favor. Now they're sitting on a profit, and it feels good. But that good feeling comes with anxiety. What if the profit disappears? What if they give it all back? The fear of losing what they have becomes overwhelming, so they take the profit early, banking a small win when they could have had a large one. Over time, this pattern becomes automatic. Cut your winners short. Let your losers run. It's the exact opposite of what successful trading requires, and it's driven entirely by emotions that made sense in the evolutionary environment, but are catastrophic in financial markets. Breaking free from these patterns requires something that sounds simple, but is actually incredibly difficult. It requires treating trading like a business rather than like gambling or a game. Business owners don't expect every decision to be profitable. They know that some marketing campaigns will fail, some products won't sell, some employees won't work out. They make decisions based on expected value across many iterations. They track their metrics rigorously, and they adjust based on data rather than emotion. Traders who escape the beginner phase adopt this exact mindset. But here's where it gets even harder. To develop a genuine edge in the markets, you need data. And to collect meaningful data, you need to execute the same strategy consistently across at least 100 trades, preferably several hundred. That means you need to keep doing the same thing even when it's not working, even when you're losing money, even when every instinct is screaming at you to stop and try something different. You need to trust that your edge will emerge over time, that the probability will work itself out, that short-term results are just noise. How many people have that kind of discipline? How many people can watch their account shrink for weeks or months while sticking to a plan based on nothing but statistical theory and faith in their backtesting? The answer is very few, which is exactly why very few traders succeed. The ones who make it through have usually experienced something that changed their relationship with money and loss. Maybe they lost enough that it stopped hurting in the same way. Maybe they developed their strategy so thoroughly, with such rigorous testing, that they had complete confidence in the math even when the emotions were screaming. Maybe they started with enough capital that the inevitable drawdowns didn't threaten their lifestyle. Or maybe they just have a personality structure that handles uncertainty and loss better than average. There's also the problem of feedback loops and learning in trading. In most skills, you get clear feedback that helps you improve. If you're learning guitar and you hit a wrong note, you hear it immediately. If you're learning to code and your program has a bug, it doesn't work. But in trading, you can make terrible decisions and win. And you can make excellent decisions and lose. This broken feedback loop makes learning incredibly difficult because your brain naturally wants to repeat whatever led to pleasure and avoid whatever led to pain. But in trading, that algorithm is actively harmful. A beginner might risk half their account on a single trade based on nothing but a hunch, and if they win, they feel like a genius. They've just been reinforced for behavior that will eventually destroy them. Meanwhile, another beginner might execute a perfectly sized trade with excellent risk-reward based on a legitimate edge, and lose because the probability didn't work out this time. They feel like a failure. They've just been punished for doing exactly the right thing. Over many trades, the person with good process will succeed and the person with bad process will fail. But in the short term, the feedback is random and often backwards. This creates a situation where beginners need to develop the wisdom to judge their trading based on process rather than results. But they don't have enough experience to know what good process looks like. They're trapped in a catch-22. The only way out is education from legitimate sources, rigorous journaling and self-analysis, and enough trades to start seeing statistical patterns emerge from the noise. But most beginners never make it that far because they blow up their accounts first, or they get so frustrated they quit, or they keep strategy hopping without ever accumulating enough data to learn anything. Another factor that keeps traders stuck is the illusion of complexity. When something isn't working, the natural human instinct is to make it more complicated. If one indicator doesn't work, maybe 3 indicators will work. If looking at one time frame doesn't help, maybe looking at 6 time frames simultaneously will reveal the truth. Beginners tend to believe that successful trading must be complicated because it's difficult. But these two things aren't the same. Trading is difficult because it requires emotional mastery and patience and consistency, not because it requires complex mathematical models or screens covered with dozens of lines and indicators. Many professional traders use remarkably simple strategies. They might trade based on nothing more than support and resistance levels, or a simple moving average crossover, or basic supply and demand zones. What makes them successful isn't the complexity of their strategy. It's their risk management, their position sizing, their patience to wait for the highest probability setups, and their ability to execute the same plan over and over without emotional interference. A simple strategy executed with discipline will always outperform a complex strategy executed with emotion. But beginners don't believe this, because simple strategies feel like they can't possibly be enough. There must be something more, some secret layer they're missing. So they add more, study more, complicate more, and in the process they usually just create more opportunities for confusion and emotional decision-making. Each additional indicator is another thing to monitor, another opinion that might conflict with the others, another reason to hesitate or second-guess or freeze at the critical moment. The role of capital also cannot be ignored. Many beginners start trading with accounts that are too small relative to their financial needs and expectations. They have $5,000 and they need to turn it into $50,000 in the next year to make their lifestyle work. This creates psychological pressure that makes patient, disciplined trading almost impossible. They need big wins, so they take big risks. When those big risks don't pay off, they take even bigger risks trying to get back to even. This is called revenge trading, and it's a death spiral. Professional traders typically risk 1 to 2% of their account on any single trade. With a $5,000 account, that's $50 to $100 per trade. If you're making $50 on your winners and losing $50 on your losers, even with a solid strategy, you're going to make progress very slowly. For someone who needs trading to pay their bills, this pace feels impossible. So, they violate the risk management rules, they overtrade, they take setups that don't meet their criteria, and they eventually lose everything. The irony is that if they had more capital to begin with, or if they approach trading as a long-term skill development process, rather than a short-term money solution, they'd actually have a much better chance of success. There's also the influence of trading culture and social media. Beginners are constantly exposed to highlight reels, people posting their best trades, their biggest wins, their most accurate predictions. Nobody posts the boring trades, the small losses, the weeks of break-even grinding that characterize most professional trading. This creates a distorted perception of what trading should look like. Beginners think they should be making huge wins consistently, and when they don't, they feel like failures. They don't realize that the person posting screenshots of a $10,000 day also had many days of small losses that they never mentioned. This comparison trap extends beyond just results. Beginners see other traders using complex platforms with multiple monitors, sophisticated indicators, expensive courses, premium data feeds, and they think they need all of that to compete. In reality, some of the most successful traders work from a laptop with a basic charting platform. The tools matter much less than the person using them. But convincing a beginner of this is almost impossible when they're surrounded by messages telling them they need this software, that course, these tools, that mentorship program. Breaking free from the beginner phase ultimately comes down to a shift in identity and purpose. As long as someone sees trading as a way to make quick money, or prove how smart they are, or feel the thrill of being right, they'll stay stuck. The people who progress are the ones who start seeing trading as a craft to be mastered over years, a skill that requires patience and humility and continuous learning. They stop caring about being right and start caring about making good decisions. They stop chasing profits and start managing risk. They stop looking for the Holy Grail and start building a systematic approach they can execute consistently. This shift doesn't happen because someone reads the right book or takes the right course. It happens through painful experience, through losses that teach lessons no tutorial ever could, through the slow accumulation of market time where patterns start to become visible not because you learned them, but because you lived them. It happens when you finally accept that the market doesn't care about your bills, your expectations, your hopes, or your fears, and that the only thing you can control is your own behavior. The traders who make it are the ones who can look at a string of losses and say, I followed my plan. The probability just didn't work out this time. I'll keep executing. They're the ones who can have a massive winning trade and say, I got lucky within my system. This doesn't mean I should increase my risk or get overconfident. They're the ones who can watch other traders making money with strategies they don't use and say, that's great for them, but I'm going to stick with what I've tested and what I understand. Most traders never escape the beginner phase because escaping requires something rare, the ability to do the boring, unglamorous work of tracking every trade, analyzing mistakes without judgment, sticking to a plan even when it's painful, and treating trading like a profession rather than a hobby or a gamble. It requires accepting that you'll never predict the market. You'll only participate in it with slightly favorable odds that emerge over hundreds of trades. It requires building your entire approach around what you can control, your risk, your position size, your entry and exit rules, while accepting complete uncertainty about everything you cannot control, which is everything else. The market will always be there, creating new beginners, chewing them up, and spitting out the ones who can't adapt. For those who can, who develop the patience and discipline and psychological strength to survive the learning curve, trading can become a genuine skill. But make no mistake, most will never get there. And that's not because they're not smart enough or didn't work hard enough. It's because trading demands a type of mastery that goes far beyond technical knowledge. It demands mastery of yourself, and that's the hardest thing any person can achieve.